Hey, good morning, everyone. Marty Missouri here, October 30th, 2021, with your weekly macro update. Going to do the usual, talk just for a minute about our index score, run through a few charts with you. I think it's going to be pretty quick this week. Nothing, earth-shattering to discuss. Certainly a lot going on out there. We're spending a lot of time at the moment just really looking deep into the metals complex, what we should expect going forward with regard to supply, capacity, the big push to renewables and what that means for the industrial metal space, and of course what that means for energy and so on. So lots more coming from us in the days and weeks to come. So here's our index. We did drop from a 25 to an 18.75. Slowing growth, I think we can say, for sure. A lot of optimism over the fourth quarter, though. Just listened to Bank of America's chief economist, and she sees 6% growth for Q4. Makes a pretty strong case for that. So we'll see. Okay, jumping to the graphs for you. Here is from the GDP report, personal consumption expenditures. That's a positive. Consumer spending was up, despite a letdown in personal income. Now, know that that decline that you see there was 100% about the expiring of unemployment benefits here recently. So, of course, personal income is going to go down. The fact that personal income went down and nevertheless consumer spending went up, of course, that would be viewed as a positive. Personal savings rates continue to decline. I think it was 9.4% at the last read. Now it's 7.5%. I guess all things being equal, that means people are spending more money. There is quite a bit of optimism in some circles that even though these big stimulus checks that were so huge to a lot of the economic numbers over the last year aren't going to be coming going forward, we don't suppose anyway, people have a ton of savings to spend. And my only contention with that is that I have seen somewhat sketchy consumer confidence. And people, it's very interesting when you look through the surveys, the one this last week in particular, people are very optimistic about the jobs market, but not so optimistic about the economy, which is interesting. Typically, the two go hand in hand. What does that mean? I don't know, but it's something, I guess, that's going to be interesting to look back on as we see how economic conditions develop. Initial jobless claims also continue to come down, 281, another decline week over week, and continuing claims are continuing to drop as well. Of course, that all makes perfect sense. The Caterpillar global sales used to come out monthly, now it's coming out quarterly. A little decline there. We were rising at a 15% global pace, 14% this last quarter. Asia, interestingly, contracted. 4% less sales in Asia, less in North America. Latin America, we still do like the Latin America space. Brazil is a political nightmare here at the moment. Chile is not much better either, but Brazil's the one to keep our eye on. Europe, Africa, Middle East, they lumped those together. Those were up 22%. So, interesting, slight contraction there. Looking at, some pretty substantial infrastructure spending to come. So it'll be interesting to see what that looks like for Caterpillar in the quarters to come. The Chicago Fed National Activity Index went below zero. 43 of their 85 indicators this last month were up, 42 were negative. And it doesn't say recession, but it does say slowing growth, at least for the moment. And then last one, in terms of our inputs, is the sector SPX ratios. So what we do here is we take the more economically sensitive sectors, and then these last three are the economic defensive sectors. Above 100 means that the sector is actually outperforming the broader market. And I think last time I showed you this, all but maybe one of these more cyclically sensitive sectors were outperforming the S&P. Now it's just tech, and then consumer discretionary has really picked up here of late. It is earnings season, so you're going to get, big company earnings that are going to really push that when you look at the concentration in these spaces. But financials really rolling over here relative to the S&P, materials as well to some extent, energy, is that kind of a rough go of it here of late. We did cut our exposure. We're hedged out for several months, but we're certainly allowing some downside in that position. Industrials, slightly less than the S&P, but it's not like the defensives are screaming either, right? So the defensives, particularly here at U.S. Staples, has been a real weak space. We think there's value there. We think there's good portfolio diversification or balancing there as well. Pretty good dividends as well. So we added a bit to our position there recently. But utilities and healthcare. So it doesn't tell us a lot, but it's not saying that things are all that robust when it comes to market signals. I do want to pull in one more graph for you, and that's the employment cost index. Now, this happens to be, from what I understand, the Fed's most important gauge of wages, right? So that is, I believe, an all-time high for this index. I think, yeah, we've gone back as far as we can go here. And that's quarter over quarter, seasonally adjusted, and that's big, right? Why is that important? Well, folks, wages are, as economists like to say, they're sticky. It takes a lot for an employer to even consider cutting wages. And we know about the incentives, and we just marvel at how much what used to be the lowest paying jobs are willing to pay just to get people to come to work. Those who would suggest that that's not going to get passed through to the consumer, I think are not suggesting a reality, at least in this economy right here. So just more fuel for those of us who think inflation is going to be hanging around on a trend basis at a higher rate than we've gotten used to the last few decades. Certainly not at a higher rate than we've seen recently, but a higher rate than we've gotten used to, I'll say it again, over the past few decades. Other than that, let's see, durable goods were okay. New home sales were better than expected. I didn't show you the consumer confidence numbers. Let me pull that up. So here are the three that we track. I mentioned the conference boards, slight improvement. University of Michigan dipped back down a bit, and the weekly Langer Comfort Index has really been rolling over, and that's the one that actually had been holding up while these were beginning to roll over. So this is not a real rosy picture, particularly when we're looking at a stock market at all-time highs, which tends to influence consumer sentiment as well. So I mentioned the B of A chief economist. She thinks it's just going to be a rockin' and rollin' Christmas season. May absolutely be right. I could certainly see it being good. But, looking at these, these consumer confidence surveys, and, there's reasons to wonder. So we had some manufacturing PMIs that were positive that I think speak well about what we'll see, I think, next week in the manufacturing ISM index. Inflation numbers came in about as expected. 30-year mortgage, 3.3%. Mortgage purchase apps were actually up week over week, although refinances were down to their lowest level since January 2020. The CoreLogic Home Price Index rose 19.7% year over year in August, so home prices continue to go. We talked about GDP earlier this week. Trade deficit was up a bit. German business confidence off a bit. Eurozone inflation was up quite a bit more than expected. Shouldn't be a big surprise necessarily. Spain's PPI was through the roof, 24% year over year, producer price index that is, and so on. So folks, it's mixed the world over, I guess you'd say, economically speaking. We're clearly seeing some pretty strong inflationary pressures. That's a topic we're going to continue to dwell on going forward. As I've said time and again, I think getting the currency, getting the inflation narrative right for the next few years is going to be key to good investment performance. Thank you, as always, for watching and listening. Be back soon. Take care. Bye-bye.